Hey everyone, this is Terry with Futures IO, and as always, I would like to thank you for joining us today. It is my pleasure to welcome back Ryan Curran for today's webinar on Bitcoin and cryptocurrency tax strategy. If you have questions, please feel free to type them into the questions box, and we'll do our best to answer them at the end of the event. If you're watching us on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar, and as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @FuturesIO. And now, without further delay, I will hand it over to Ryan, and you should get the pop-up to share your screen any second. Right, there we go, looking great.
Very good. Thanks, Terry. Thanks for having me again. I really appreciate the ability to speak on this topic with everyone. Hope everyone's ready for some, I think, very good information here. This is certainly a hot topic of late with respect to taxation, so I'm happy to present on it. So we're going to jump right in here. The name of this webinar, Cryptocurrency Tax Information for Traders. There's also a lot of just good general tax information about crypto and capital transactions in general. And we'll get right into that. Just a little bit about me. I'm happy to provide this PowerPoint as well for distribution. This way, if you have any questions or want to get further opinion, further discussion on these topics, please feel free to reach out. So just a summary of what we're going to be talking about. We have 5 main bullet points here. First, I'm going to give you an overview of crypto taxation. Secondly, we're going to talk about exchanges or conversion of crypto between currencies and the tax implications, reporting requirements for crypto. This next topic here, thoughts on amended late filing of crypto-related activity. In my opinion, this is going to be a major issue and item that's going to be very sensitive over the next couple of years, so we'll spend some time on that. And then we'll briefly touch on professional trading in crypto and the tax implications involved. Finally, I'll open the floor for some Q&A. So to jump right in here, to give you an overview of crypto taxation in general, a little bit of history. So IRS has issued really only one authoritative piece of guidance on digital currency, and that's IRS Notice 2014-21, which you can Google it, you can read it. It has some good information, but it's a 6-page document. It's pretty brief. But that's the only authoritative guidance that we have as traders and as tax advisors on how to deal with cryptocurrency. So the takeaways from this IRS memorandum here are that crypto is ultimately considered property for tax purposes. Accordingly, the tax rules related to property apply to any cryptocurrency transaction. So property has a very broad definition, can mean many different things. Property like real estate, property like money or currency. In this context, it's really more of a capital asset. That's how the IRS refers to digital currency. Sales of crypto are generally subject to capital gain and loss treatment after the sale. Okay, so what that means is, you buy for $100, you sell for $200. There's a gain of $100. That's generally going to be subject to capital gain treatment, whether it's short or long term, in conjunction with the same type of treatment that any other capital asset or security would be entitled to. Crypto was never declared and has not been declared as an actual currency by IRS. And an important factor there is that because of that reason, the typical tax rules associated with currency trading don't apply. Normally, currency trading is ordinary in nature, ordinary income or loss. It does not apply to crypto transactions. These are considered the same in the eyes of the IRS as a stock, bond, option, etc. One major topic here, this is very relevant, I think, to many of my clients who have spoken to me about these types of issues, but crypto as compensation. Because cryptocurrency had very little value for years and years, and it's kind of been a little murky as far as a record of it, so to speak. Many people, in my opinion, and just kind of based on empirical evidence, just speaking to others, were compensated in crypto at some point for certain transactions, particularly within the IT space, right? It's very common in there to be paid in crypto for certain tasks. The way it works with crypto is the same as if you're working for a public company or a private company that has an actual stock value. And essentially, any crypto received by someone rendering services to another is considered compensation. And when you receive that crypto, when you take custody to that crypto, whether it's in your own crypto wallet through Coinbase or some other platform, technically that income needs to be included in your tax returns for that year in question. And the way to evaluate what should be included is you're just looking at the fair market value. So if you were compensated in one Bitcoin in 2016 for $500, when it was worth $500 at the time, you need to include that $500 in income. And if you're a freelance or contractor type person rendering services, that compensation from the crypto would be subject to self-employment tax. So not only are you getting hit with a ordinary income tax, it's also going to be includable in self-employment income, and there's a separate self-employment tax surcharge that applies to it. The cost basis of one's crypto received in that context is just the fair market value on the date that one receives it. So using the example I cited earlier, you render services to someone in 2016, they gave you one Bitcoin, which was worth $500. You report that $500 in income in 2016. Technically, your cost basis in that item of crypto is $500. So if you were to sell it the next year in 2017 for $500, there would be zero gain because your cost basis is the $500 amount. You already picked up income tax in it in the prior year. Again, I would venture to say that maybe 95% of people that received crypto for compensation actually reported it. And again, that's an opinion. It's not based on anything other than that, but just getting a sense from kind of the community at large within this space, a lot of people did not report crypto as compensation. So we'll talk about that as well. A silver lining for reporting crypto as compensation, though, is that you can deduct your normal, ordinary, and necessary business expenses against that type of income. So if you're providing consulting services or you're providing some kind of specialized trading consulting, you can deduct your normal business expenses against any self-employment income or income generated by declaring the crypto you received as compensation as income. Something important to note. Crypto earned from mining, to the extent that anyone was actually mining or creating any kind of cryptocurrency, with the advent of Bitcoin's rise, especially in 2017, the latter half of 2017, the term ICO has become a very popular acronym within this space. And just to give some context, that's generally someone creating a new type of crypto, new set of algorithms, and mining, basically getting an initial cache of this type of crypto. And the IRS says that if you generate any crypto from the mining activity, you're supposed to report in income the amounts that was received as of the day that you were basically given a crypto token, 1 unit of crypto for your work in rendering these algorithms and kind of solving these math problems. The self-employment income question here is a little more obtuse. It's not as clear. Many people that I know of in this context were kind of running passive mining operations. They would have, a computer running in a room, so to speak, and the crypto unit generated from such activity, in my opinion, would not be subject to self-employment income. It's generally more passive in nature, in my view. Now, if someone was making an activity of doing it, every day, and that's all they did, and that they were focused on continuing to mine, an argument could be made that it was trader business and would be subject to self-employment income. Generally speaking, though, I don't think that a casual miner would be subject to self-employment income here. Sales of crypto. So let's just go through kind of how it works on an overall basis. So we'll take someone dabbling, for example, maybe not trading it actively, but someone dabbling it just to illustrate the example here. So taxpayer in this example, taxpayer purchased 1 unit of Bitcoin 7/1/17, sells the same 1 unit of Bitcoin on 6/30/18. Any gain or loss here is going to be short-term capital in nature, just because the holding period is less than a year. And conversely, if they held it for 1 extra day to bring the holding period to 1 year or over, they're going to have long-term capital treatment there. The point of these examples is to illustrate that the tax treatment of crypto is similar to any other piece of property. There's a holding period, and if you're over a year, it's long-term. If you're under a year, it's short-term. Okay? Next example here, taxpayer receives 1 unit of Bitcoin on 7/1/17 worth $2,000 and reports that his income from self-employment on the 2017 tax return. Taxpayer's basis in the 1 unit is $2,000. This kind of goes to what I was saying earlier. Any gain or loss from that sale then is calculated using the $2,000 basis, right? So if someone received a unit for work in July of 2017, they sold it in December, at the highs, really, sold it for $15,000. Their capital gain there is going to be $15,000 of sale price minus a $2,000 basis in the entity. Okay. Again, our observation here is that many people are not really reporting earning crypto from compensation. They're not reporting anything from mining, and even if they are, they're showing it as a zero basis, which really is not correct based on the clear IRS guidance here. This is a topic that's come up a couple of times. I think it's worth mentioning. Some people have received crypto as gifts. It's, again, I think fairly common in this space. So the same general rules would apply to those receiving crypto as a gift as if it was any other item. If you received a car, you received cash, you received a piece of real estate, a business, something like that. The basis for such a piece of crypto is the same as the donor's basis. Okay, so if you received a piece of crypto from someone who had mined a new offering that had no value, the argument could be made that the fair market value as of the date of mining was zero, therefore that person's basis is zero. They give it to you, it's worth $1,000 when they give it to you. Your basis is still going to be zero, but the person that gave it to you has a gift of $1,000. Okay, so this can be something that has massive gift tax implications to someone who's engaging in this kind of activity, if they're over the annual exclusion here, the annual gift exclusion, which is listed here. It's $14,000 for 2017, $15,000 for 2018. Again, our kind of opinion on this is that IRS is very likely to drill into this a lot more, and we'll talk about that shortly. So just something to put on your radar. If you've received a gift, you've given a gift, I would make sure that I's are dotted, T's are crossed, and you're protected and you understand all the implications. This is a really, I think, important topic here going into our next overall subject, and that's the exchange of crypto between different currencies. Happened all the time during 2017 and prior, still is happening. Someone has Bitcoin, they change it to Likekind, Ethereum, etc. So the IRS notice here does provide a bit of dialogue on the exchange. It does not specifically cite anything about like-kind exchanges, okay? So what the IRS notice says is if one exchanges crypto for another piece of property, the value as of the exchange date is what's included as a sale. It's what's included as income for purposes of calculating any gain or loss on the sale. However, they don't mention anything about 1031, which is a commonly known or commonly utilized in real estate. So as I mentioned here, there are kind of two separate views. Obviously the views are, does it qualify for like-kind exchange or doesn't it? So we'll dig into this a little bit further. So to talk about give you some context on 1031 exchanges, like-kind exchange, essentially what that says is a taxpayer can defer the recognition of taxable income on a sale or exchange of property as long as the proceeds from such sale are rolled into like-kind property. Okay, so in the traditional context, I'll use real estate as an example since it's a good illustration. Someone buys a building 20 years ago for $100,000. They sell the building today for $1 million. There's $900,000 of profit. Without doing a like-kind exchange, that $900,000 of profit is all taxed at long-term capital gains rates. By using a like-kind exchange and buying other property, other real estate in particular, because it's a like asset, they can defer the tax on that $900,000 until the future. So you can use this strategy to basically push out the recognition of taxable income on this kind of transaction in perpetuity. So the key operative word here is like, right? It needs to be a like asset. So real estate can be traded with real estate. Vehicle can be traded with vehicle. Crypto, in theory, can be traded with other crypto under this type of approach. And an example here of how this would work is, let's say taxpayer buys one Bitcoin on 7/1/16 for $200. Okay, when it was treading water, basically, it was at a low level. Taxpayer sells one Bitcoin on December 1st, 2017 for $15,000. Ordinarily, this would generate a capital gain of $14,800. However, let's say that taxpayer buys Litecoin on the same day for $88 using the $15,000 of proceeds. And if we can make the argument that a like-kind exchange applies, the entire capital gain, that $14,800, is not taxable. The key here is that the Litecoin in this case would have the same basis as the original Bitcoin purchased. So even though the taxpayer spent $15,000 on Litecoin, to them, from a tax standpoint, the Litecoin has a cost basis of only $200 because of this deferral. So then if the taxpayer sells the whole lot of Litecoin for $15,000 1 month from purchase, the capital gain of $14,800 is fully recognized. Okay, and that's a very crucial point here with this concept. And just overall other tax knowledge, this is I think a good illustration of how like-kind exchanges work in general. One point to bring up. So this type of really thought process and strategy is only going to be entertained by IRS or tax court for really the 2013 to 2017 tax years. And I say 2013 because that's really the advent of digital currency, in kind of a larger scale. So in 2018, the new tax plan, there's a specific provision about like-kind exchanges in the new tax plan that says that like-kind exchange 1031s are only applicable to real estate. So in my opinion, the fact that the IRS called that out specifically gives a little more credence to this like-kind exchange idea, because they're specifically leaving the door open for prior like-kind exchanges, and they're making a clear statement in 2018 that any digital currency and any other kind of like-kind exchanges will not be allowed unless they're real estate related. So in my opinion, that's one feather in the crypto like-kind exchange hat. Overall requirements here, and this kind of goes again to the whole problem. So generally, for a like-kind exchange to be effective, the proceeds from any sale need to be held at a qualified intermediary and dispersed within 180 days. So a qualified intermediary in a traditional sense is a title company, and that's a prerequisite of having a good like-kind exchange. So it's ultimately going to come down to, in my opinion, this is going to be something that's absolutely going to get challenged, and it's going to go to tax court over the next couple of years. It's going to depend on if the IRS will find that a traditional platform, Coinbase, et cetera, would be considered a qualified intermediary under the tax code. And that remains to be seen. If you have any interest in digging into this topic offline, you can do some research on what a qualified intermediary is. It's outside the scope of our talk. But again, I think this is the most critical point for seeing if anyone who took this position in the past or will take this position on prior year tax returns will ultimately be sustained. Overall, another factor here of like-kind exchanges is that the actual like-kind property needs to be identified within 45 days. So just logistically, how this would work is if you were to sell Bitcoin in December of this past year, if you had sold it for a $15,000 gain for 1 unit of Bitcoin, you would have to identify another type of crypto to invest in, to put the proceeds in within 45 days. Obviously, a very easy thing to, a very easy hurdle to clear, because you can invest in, one of really over 1,000 of these using many exchanges. So that part of the issue would be satisfied, and then certainly closing in 180 days would also be satisfied easily. The question really is the qualified intermediary, and that's what's going to come down to, in my view. Overall crypto reporting. This is something that I've dealt with extensively this filing tax season, and it's important just to go over it, just to make sure everyone's aware. So for compensation, if one is a sole proprietor, single member LLC, that's taxed as a disregarded entity, it's going to be reported. Any crypto for compensation, the value of such would be reported on Schedule C as extra self-employment income. Same thing if you have a partnership and you've rendered services in a partnership and you've been compensated in crypto. It's getting reported on your normal partnership tax return, Form 1065, really as just a gross receipt. So you render services, you get paid for services. It's going to get reported right there in 1065. If you're an S corporation, same thing. Form 1120S for S corporations, and then finally, if you're a C corporation, gets reported on 1120. The crypto sales themselves. So these are reported on Schedule D, like any other capital gain or loss from security sales, etc., with box C or box F checked, and that would be on your Form 8949, which is the form that's used to report individual sales. And the reason that is because the exchanges haven't reported any sales transactions. They haven't been required to report anything to IRS, and we'll talk about that in a bit. But that's the reason for marking box C or box F. And this also kind of puts the IRS on notice that you're being forthcoming and reporting this stuff without them having to chase you for it. So to the extent that you may, if there's any casual crypto traders and even more aggressive crypto traders, when you do your tax returns, make sure you're reporting this stuff. It'll probably go a long way if IRS ends up digging into blockchain a little more and seeing who's doing what. Your name might not be on the list. So I think it's a good precautionary measure. Gift tax. So kind of touching back on our earlier topic, and I want to stress, I really see this as a big potential issue, depending on how much of a gift, quote unquote, is given from one person to the other. If we're talking about 100 coins that someone had, and they gave those coins to someone else in December of 2017 when it was almost $20,000, there's a major gift tax implication. So it's very important that, again, the person that's either, if you are on the receiving end or you were giving, that you understand the implications, because just for overall estate planning purposes and one's lifetime gift tax exclusion, this stuff can really trip you up if you're not doing it correctly, and there's massive penalties that the IRS can impose. So suggestions for amendments and late filing overall. So just kind of giving a little bit of a 20,000-foot view here of the situation. So there are obviously many taxpayers that have not reported crypto activity. And I think the thought at the time was that the IRS didn't have a way to track it. It's anonymous, so on and so forth. But at least my understanding of blockchain in general, and this is why it has use outside of crypto, is there are basically almost a perfect audit trail that's available. So if the IRS gets sophisticated enough to really dig into these blockchain ledgers and can figure out who's doing what, then they can kind of index that back to a person's tax returns and start sending out notices for underreporting. So that's going to be the common issue with people that have not disclosed. I mean, so this is something that, I think everyone that hasn't done it really needs to kind of think about and maybe look through their old records and see what they can do. So the penalties and interest that are potentially going to be assessed on persons by IRS who aren't reporting crypto, just general substantial understatement penalty, which can come about if someone has underreported 25% of their income. So if IRS finds that there's, sales in the course of a year that were in excess of 25% of a taxpayer's income, otherwise reported income for that year, they can assess the substantial understatement penalty. In addition to interest. IRS interest overall isn't that material. It was ranging from 3 to say 6% as of today. But over time, if they find people that were engaging in activity in 13, 14, 15, if they end up getting around to accusing one of not reporting the activity in 2019 or 20, you're talking about potentially 7 years of compounding interest, which can really make the potential penalty massive. In addition to that, the records from really the advent of crypto, we'll call them, even though blockchain was in force, a lot of people that are engaging in either mining or trading at that time, their records on cost bases may be a little hazy. They may not be able to prove how much they paid for something. And IRS can potentially take a position that anything that they received, that the taxpayer received for that year, is all going to be income. And then proving the cost basis is going to be a big problem, because IRS is not going to give a taxpayer credit for cost basis on a certain sale unless they can prove it. Okay. Our thinking on this is there's an amnesty program available for offshore voluntary compliance. Just to not give a history lesson, but this became a big problem for people that had money in offshore accounts about 12 years ago. And this happened with the advent of UBS. It was a big situation. You can certainly look on some old news. It's actually quite interesting. Anyways, IRS announced an amnesty program for people that did not report this income at the time. And there was a penalty, but it was not as severe as it would have otherwise been. The thinking is that there will be an amnesty program of some kind, probably taking place in the next year or two, once IRS kind of understands the scope of how much is underreported. And there'll probably be similar relief for taxpayers. So in other words, if IRS announces an expected amnesty program, you may pay a 20% penalty on the tax due on any crypto, and maybe a small interest rate, and then the problem essentially goes away. It is voluntary in nature, so to take advantage of it, there'll probably be a stated deadline for doing so, and you'll have to come forward and basically report the income and the related tax. What I want to make clear is I'm not advocating to wait for any amnesty program, because it's not guaranteed. I'm just trying to look at it logically, and given probably the scope of the issue, of underreporting, the IRS is going to have to do something, because they were asleep at the wheel for so long. They have to kind of make good on they have to take some of the blame for this. So I think that they'll offer some kind of amnesty program. But again, my advice is understand, if you haven't filed anything for the past couple of years, understand the implications and get the information organized, and then make a decision on filing. Another item here, and I know that this is tailored for trading in particular, that this overall webinar, I've given a couple of chats on this before. Professional trading rules, I don't want to go into it too much here, because it's, again, outside the scope. This webinar is supposed to be specifically related to crypto. But in any event, if one is a professional trader, if you're engaging in a significant amount of crypto transactions, or you've done so in the past, and you can make an argument that, based on the facts of your situation, if you're engaging in an excessive amount of trades, really 1,000 trades a year here is what we're looking at. And this is an aggregate of crypto and other currency, other securities. If you're trading actively, you should be able to take advantage of any ordinary and necessary business tax deductions on the crypto income. And that would be home office costs. That would be, any of your data fees, hosting, etc. I mean, the whole litany of things that are available to professional traders would also be available to professional crypto traders. And really, even persons who may have engaged in some crypto activity kind of on the side, that have an active trading business otherwise, for normal securities, futures, etc., could potentially have the same type of professional tax treatment afforded to their crypto activity. So that's something that I think very important to think about. With respect to the mark-to-market election on crypto, this is something that, you know, it's a little late to do, obviously, for these earlier years, but certainly the same types of benefits that are available, like I just mentioned. I mean, retirement income, retirement plans, health insurance, you can pay yourself a W-2 wage. These same types of benefits that are available to professional traders in other types of securities, we'll call them, not crypto, are going to be available to persons who are professionally engaged in the activity of trading crypto. I want to actually step back one slide for the reporting requirements, because this is another potential bombshell. So there's something called an FBAR, which is a foreign bank account reporting. It's a separate form, separate requirement that was mandated by IRS years ago, and it's actually now the FinCEN Form 114. It's another foreign asset reporting requirement. If one holds assets over a certain dollar amount in a foreign country, a non-U.S. country, and you're a U.S. citizen or a resident alien of the United States, you have a requirement to report said assets. So there's a couple of forms that you'd file, but the gist of it here is that if you don't report crypto assets, say over $100,000 that may be held in accounts not in U.S. countries, you can get hit with a massive penalty. I mean, the penalty can be as high as $50,000 per instance, you know, per account. And it's just an area that you don't want to really mess with. So you have to think carefully about, you know, decisions that you make with reporting if you have crypto valued assets over $100,000 in other countries. Okay. And that's really what I got on this topic. Kind of covered a lot. I can open up the floor to some questions.
Okay, sorry about that. My mute button wasn't working. Here we go. Your 1031 example was buying Bitcoin with US dollar and then selling it back to US dollar and then buying Litecoin 1 month later. What if you sell a coin and exchange it to another coin with no US dollar involved?
The rules would be the same as any other 1031. So the currency itself, in my opinion, is really neither here nor there. So the rules of the 1031 exchange just state that it needs the proceeds from a sale, you know, proceeds in whatever dollar or whatever currency type, you know, USD, non-USD, need to be held by a qualified intermediary, and then you have to close on the new currency sale within the prescribed time frame, which is 180 days.
Okay. If you invest one Bitcoin in a company that trades for you and you get returns periodically, how do you report the returns on your investment?
So it would be, you'd report basically fractionally. So if you're getting, I guess, let me actually redirect the question. So would this be you're investing in a fund of some kind? Because if you're investing in a fund and you're getting a distribution from that fund, you'd really want to apply the distributions you're receiving to whatever your fractional, you know, cost basis is, we'll call it. So if you're putting up one Bitcoin and you're receiving, you know, money on an ongoing basis, you'd have to kind of allocate that money towards your basis in the Bitcoin. So for example, if I mean, very good question overall, but just to give some context. So you put one Bitcoin in at $15,000. Let's say your liquidation value is $15,000, but you've received $2,000 in distributions. Okay, you have a value of $17,000 in that investment because you can still trade your Bitcoin in. You can still redeem your investment for $15,000. You received $2,000. You'd want to do a pro rata reporting of that income coming in. So in that example, it'd be, like 17 divided by 15, basically. I'm happy to kind of flesh that out a little bit more offline because it requires some math and some writing. It's not something that's that easy to answer over the phone clearly. So I'd be happy to talk to you via email on that one.
Okay. What about cloud mining like Genesis, Hashflare, etc., payments and expenses on income from investing in cloud mining?
So if you're receiving, again, any fractional shares of any kind of currency from cloud mining, that you'd start there with what's reported as income. And then if you're incurring expenses in running the mine, you deduct those expenses from, whatever the fractional income you received is. So if you've received fractional coins, we use Bitcoin as an example. Probably not a great one anymore, but we use that as an example. So if you're receiving fractional Bitcoin, let's say the fractional Bitcoin's worth $5,000, you're forced to come up with $2,500 of operating expenses. You're going to end up showing a profit of $2,500 in your tax return.
Okay. All right, if you have any more questions, please feel free to type them in. Okay, I have a question. Give me a second to figure out if I can figure a way to form it. So Bitcoin itself is not seen as a currency by the IRS. You said it's seen as property?
Yes.
How does that compare to a stock? Is stock seen as a property as well?
It is, yes. But so stock is specifically outlined in the Internal Revenue Code, and the tax treatment of such is outlined specifically for securities in the Internal Revenue Code. So that's why you can't do like a Likekind exchange on a stock, on a security of that kind, because it's specifically outlined in the code. Whereas Bitcoin's kind of this, and really crypto in general is this kind of nebulous thing that's just evolved, and the IRS hasn't been able to. There's no regulations on it, basically.
Okay.
Right. So further iterations of tax code will likely specifically spell out digital currency.
Okay. That answered my question. If no one else has here we go. Thoughts on Coinbase and what the IRS... Let me see if I can read this. Okay. Thoughts on Coinbase and what the IRS forced them to do so far as customer records were subpoenaed, yes.
So, that's a great question, and that's kind of part of the reason why I have more of an ominous tone in my presentation is that IRS has this information. So, certainly the IRS, without retaining consultants, in my view, is not sophisticated enough to really pinpoint who's doing what. But now that they've subpoenaed information and retained consultants to look at this stuff, I think there's a very good likelihood that IRS will figure it out and will be able to trace this stuff back. And so Coinbase being forced to turn this information over, is it legal? Isn't it? Certainly I think it's within the IRS's legal authority to request this information. They're trying to make sure people aren't avoiding taxes. And Coinbase is just the most visible platform, so they're a natural target. I'm sure there are many other less visible platforms that persons are engaging in, and we'll see where the IRS goes if they're able to get their hands on those particular platforms. But certainly Coinbase is out in the open, so that's an obvious target. And I see that people who are transacting there really need to report their activity, because I think it's a certainty that IRS will figure it out. If someone's on some other platform, again, the rules are the rules. You need to report the income, but can the IRS find it? I don't know. Maybe, maybe not. If anyone engaged in activity, if anyone traded on Coinbase with another more nebulous exchange, the IRS can probably find it, or their consultants at least can find out where it came from. So that may enable the IRS with enough effort to kind of figure out the whole map, so to speak. I'm sure that'll take a lot longer than a year or two, but I think, the information's there. It's all out there. So it's just about finding it.
Okay. Let's see. There's a question. You said we have to report assets held overseas if they are worth 100K. What if it's less than 100K? I have an account with Binance, which is overseas, wondering my tax ramifications there.
So if it's a cash account, the requirements actually, any cash accounts with a value that reached over $10,000 at any point during the year would need to be disclosed. If it's a cash account, okay? If it's a crypto account specifically, that you might have transferred some coins from domestic to offshore, and the value was not over 100,000 at any point during the year, I think you're good. I think you're okay, because that's not what the rules say. But if it's went over 100,000 at any point during the year, you disclose it. And additionally, it's not like you have to pay tax on that money by just disclosing it, okay? It's just an information reporting requirement. So there's really no, it's not like someone who has $10 million overseas, if they report those assets overseas, which many people do every year, there's no immediate tax from just reporting those assets. It's just strictly information. If there's income generated from those assets, that stuff needs to be reported on U.S. tax return if you're a U.S. citizen or resident alien.
Okay. I have a question on what if you invested in something like BitConnect or something that turned out to be a scam and you lost that investment. Are you able to take a tax break on those kind of losses that might have been lost in some kind of
like a scam?
Yes, a scam, I guess would be the only way to call it.
Right. So the general rule is that you just deduct the loss as a capital loss on Schedule D, and then you can net it against other income or other capital losses. If you invested in this money through say a professional type of trading business, you can take the loss as ordinary. And furthermore, IRS has in the past allowed basically a special relief for the capital loss limitations of $3,000 for certain types of scam activities. So they haven't said anything specifically on Bitcoin, but you may be able to kind of draw a connection between prior IRS scam relief and current scams that are being engaged in from a digital currency.
Okay. All right, I am not seeing any more questions. Thank you for the webinar today, for the information, and for spending some time with us this evening.
My pleasure. Thank you very much.
Absolutely.